Today, we are breaking down Ferroglobe's second quarter earnings. And let me tell you, the headline numbers hit a much more interesting story. The market saw an earnings miss, but looked right past it. And for good reason. It seems they spotted a powerful operational turnaround. So let's dig in.
Right, so on the surface, this quarter looked like a clear miss. GAAP EPS came in at a loss of 6 cents, which was below what analysts were expecting. Not a great start, you'd think.
And it wasn't just the earnings. Revenue also fell short of the forecast, so you've got two headline misses. But, and this is the important part, that's not where the market focused at all.
So what got investors so excited? It was this number right here. A massive $48 million positive swing in adjusted EBITDA. I mean, they went from a $27 million loss last quarter to a $22 million profit this quarter. That is a huge reversal.
This really raises the key question, right? How can you miss on the top and bottom lines, but crush it on profitability? This stark contrast is exactly what we need to unpack. So let's start by looking under the hood.
The positive reaction from the market? Well, it wasn't a mistake. It was investors recognizing this powerful rebound happening just beneath the surface, all driven by the company simply getting its plants back up and running.
And just look at the sheer speed of this turnaround. We're talking a 26% jump in revenue from just last quarter. And that was fueled by a 27% surge in how much they actually shipped out the door. The main reason for this? They got their operations in France restarted, which brought a ton of production capacity back online.
But here's the thing. This rebound wasn't happening uniformly across the globe. Ferroglobe's performance was a classic tale of two completely different market environments, one in the US and one in Europe.
And this slide illustrates the core conflict perfectly. Over in Europe, you had a flood of cheap Chinese imports that just crushed silicon metal prices and basically wiped out local producers' market share. But here in the United States, it was a totally different story. Strong trade protections, things like anti-dumping duties, created this protected, really favorable market that boosted prices and volumes for Ferroglobe.
So the crucial point here is how management reacted. They didn't just sit back and take it. No, they showed some incredible operational flexibility. They actually converted two of their furnaces, one in the US and one over in Europe, switching them from making silicon metal to making ferrosilicon, so they could chase those much better profit margins in the protected US market. Really smart move.
Now, this deep split between their two main markets created a huge problem when it came to forecasting the future. With the company's fate so tied to government trade policy, management basically threw up their hands and said it's impossible to give a clear outlook.
And that's exactly what they did. They pulled their full-year guidance. As the CEO, Mark Olivi, put it, there's just too much uncertainty around these big trade policy decisions. They essentially said the range of possible outcomes is just way too wide to give anyone a reliable forecast right now.
And that uncertainty is all centered around these key dates coming up. These are regulatory deadlines that could dramatically shift the entire landscape. Now, while that creates a lot of short-term fog, these dates also represent massive potential catalysts for the stock that could really define their business environment heading into 2026.
So, what does this all mean for the stock? How do you even approach a company with strong operations but this massive political risk hanging over it? Well, here's our take, including our rating and a specific trade idea.
We are initiating coverage with a market perform rating. And why market perform? Well, it really reflects that delicate balance between the company's strong operational execution on one hand and these very significant, very real external risks tied to trade policy on the other.
Our thesis here is pretty straightforward. Management is executing really well. They're showing discipline and flexibility, and that provides a solid floor for the business. But, and this is a big but, the stock's future isn't entirely in their hands anymore. Its path is now almost completely dependent on these upcoming policy decisions that are going to define their market for the next year and probably beyond.
So based on this really unique dynamic, we came up with what we're calling an outrageous but plausible trade idea to think about.
Remember that tale of two markets? Well, you could construct a pairs trade based on it. The idea is this. You go long Ferroglobe to capture that upside from its protected US business and its operational agility. At the same time, you'd short a pure-play European competitor, one that's way more exposed to all that import pressure and doesn't have a strong US presence. This strategy basically isolates Ferroglobe's key strategic advantage, and it could act as a hedge if the policy news out of Europe is bad, while still letting you participate in the strength over here in America.
And as always, please remember to conduct your own research and consult with a financial professional. This is for informational purposes only.